Hello, welcome to my YouTube channel. My name is Honorode Rogers. Let's take a quick recap of what we learned from the last session. Our last session we discussed bookkeeping and accounting, where we said a bookkeeper is not an accountant, but an accountant is a bookkeeper. That accounting starts from recording and ends with reporting, while bookkeeping starts with recording and ends with the trial balance and other adjustments. They also define two terminologies. We define recording and posting, how they are being used in accounting. Then we also discuss qualities of an accountant, accounting information, and also the users of accounting information. We also discuss the accounting equation, which is assets equals capital plus liabilities. And we said also that it is the double entry principle that ensures the balancing of the accounting equation. So like I said for the last session, we are going to be looking at the double entry principles. Okay, double entry bookkeeping. What is the principle? The principle states that for every debit entry, there must be a corresponding credit entry, and for every credit entry, there must be a corresponding debit entry. In a layman's language, it says you debit the receiver and credit the giver. So let's look at the principle behind the double entry accounting, the key principle. So we have the dual effect: debit the receiver and credit the giver. Then the accounting equation is the dual effect of every transaction that balances the accounting equation. The accounting equation, which is assets equals liabilities plus equity. Also note that in double entry accounting, every asset must be balanced by a corresponding liability or equity. This relationship is captured in the fundamental accounting equation. Okay, let me try to explain the accounting equation by visualizing it. Let's use a seesaw to do that. On the left hand side you see an asset, on the right hand side you see capital plus liability. For each transaction, this equilibrium must be maintained. As you can see, the seesaw is at the state of equilibrium. It's balanced. It must be balanced at all times. For instance, if you pick a transaction, you look at it, it must have two effects. One account must be debited, the other account must be credited. So when you place the transaction in the trial balance, the trial balance will balance. So for each transaction, it must balance. If the entry principle is not to be, your balance sheet is not going to balance at all. Okay, let's look at cash and credit transaction. For every transaction consummated by a company, it will either be a cash or a credit transaction. So looking at a cash transaction, here the buyer pays immediately for the goods bought. So when transaction are being paid for, there will be no need to maintain or open an account for the buyer or seller. All cash transactions must pass through the cash book. All cash transactions must pass through the cash book, and it's when the customer buys goods from the company, the customer pays for the goods immediately. That is a cash transaction. So let's look at it now. How to record a cash transaction? One, first of all, it must go through the cash book. It must go through the cash book. Then prepare two accounts. You prepare two accounts. Then identify the giver and also the receiver. Then apply the entry principle, which says debit the receiver and credit the giver. Then note all cash transactions must pass through the cash book. Okay, for credit transaction, unlike the cash transaction where customer pays for the goods immediately, but for credit transaction, customer will not pay for the goods immediately. The customer will pay in the future dates. That means the company will be expecting an inflow of cash from that particular customer, So, like I said, here the buyer is not making an immediate payment for the goods, but payment will be made in a future date. So let's look at it. How do we record a credit transaction? So first of all, it must go through either the sales day book, the purchase day book, or journal proper. The sales day book, purchase day book, or the journal proper. Unlike that of a cash transaction, I said it must go through the cash book. When in the case of a credit transaction, it will either go through the sales day book, purchase day book, or journal proper. I will explain these books later. We will get the subsidiary books of accounts. So refer to accounts, then identify the giver and the receiver, then or apply the double entry principle whereby you debit the receiver and credit the giver. Note, all credit transactions must pass through either sales day book, purchase day book, or journal proper. Like I said, I will be explaining these books when we get to the subsidiary books of account. So, for kind of a recap, please kindly note that all cash transactions must go through cash book, while all credit transactions must go through these three books which I mentioned earlier. Okay, now let's place the cash transactions and the credit transaction in the flow chart. Let's see how they flow through the ledger. Like here we have the cash transactions on the left hand side and the credit transactions on the right hand side. For the cash transactions, it goes to the cash book. It must go to the cash book and ends up in the ledger. Then the credit transactions goes through either sales day book, purchase day book, journal proper, or general journal. Then from there it flows to the ledger. They all ends up in the ledger. Just note that cash transaction and credit transaction must not go through the same book. It will either go through cash book or day books Like I said, I will be explaining the meaning of all these books. We'll get to subsidiary books of accounts. We'll get to subsidiary books of accounts. Illustration of the double entry principle using some examples. Let's do some illustrations. So Mr. Clever started business with 50,000 naira. That means Mr. Clever gave the company 50,000 naira. That means Mr. Clever's pockets reduced to 50,000 naira and the company's assets increased with 50,000 naira cash. So here, what will be the effect of this transaction on the company? So the effect will be the capital will increase. Capital will increase, while also asset is going to increase. Then the two account this transaction is going to affect. This transaction is going to affect the capital account and the cash account. So let's identify who is receiving and who is giving out of these two. So we have that applying the double entry principle. Then the capital account is giving out, while the cash account is receiving, because the cash account is rehousing the cash for the company, while the capital account is Clever's account. That's showing that the company is indebted, yes, to Clever. It's not 50,000, because there is this concept in accounting, the entity concept, that the company is an official person. So you cannot combine Clever's money and that of the company together and say, okay, it's one and same. No, it's not one and same. So the capital account represents Clever's account, while the cash account is the company's assets. So let's look at another example again. Pay 2,000 naira cash for electricity bill. The company is parting with 2,000 naira to pay her electricity bill. What will be the effect of this transaction? First of all, the effect is going to be that the asset of the company is going to reduce, which is cash, is going to reduce by 2,000 naira, while electricity bill is going to increase by what? 2,000 naira. That means, let's look at the increase in expenditure. Expenditure is increased by the electricity bill account, while there will be decrease in asset because cash is going to part with 2,000 naira. They are applying the voluntary principle, being that asset is reducing and cash is parting with money. That means cash is giving out money to pay the electricity bill, then cash account is going to be credited because it's giving out, while this account is going to be what? To be debited. More illustration on the voluntary principle. Cash sales 40,000 naira. Just say cash sale 40,000 naira. What does it mean? It means the customer paid for the goods. He or she bought cash immediately. He paid for the goods immediately. That is cash sale. So what will be the effect of this transaction? Assets is going to increase because the company received 40,000 naira cash. Then revenue is going to increase also by 40,000 naira. You can see here that increase in assets, which is cash account, is going to increase by 40,000. Then sales account, also you can also call it revenue account, is going to increase by 40,000 naira. Also, so which account is giving out and which one is receiving? As you can see, being that we are selling the goods, we sold the goods, the company sold the goods, the company is receiving cash. The company is receiving cash, that means cash account is going to be what? To be debited because the principal will debit the receiver, then credit the giver. And sales is giving out the goods. Sales is giving out the goods, as you can see from here, applying the voluntary principle, credit sales account, which is the giver, then debit cash account, which is the receiver. Then another example again, purchase goods 30,000 naira credit from Favor Limited. As the company this time around is not selling, rather the company is buying from Favor Limited on credit. Look at it, on credit. On credit. Buying on credit. So this is not like the cash transaction which we have considered before. This one is on credit. So now, what will be the effect of this transaction on the effect of this transaction? So increase in liability. Liability is going to increase. How do I know that liability is going to increase? Because we are not paying cash. We are going to be paying Favor Limited in future dates. That means we are already indebted to the tune of what? 30,000 naira. We are going to pay Favor Limited in futures. That means liability, our debt is going to increase by 30,000 naira. Then asset is going to increase also. How will asset increase? Asset is going to increase in the sense that the goods we bought came into the company, which is we are now warehousing the assets which we have bought, though on credit. So applying the voluntary principle, being that we are receiving the assets, which is purchase, we are going to debit purchase account, and being that we are indebted to Favor and we are going to pay in a future date, we are going to credit Favor's account because Favor gave us the goods, they are the giver. Favor account is the giver, while our purchase account is the receiver. As you can see on the screen, debit purchase account, which is the receiver, then credit Favor account, which is the giver. That shows that we are indebted to Favor Limited. Okay, let's consider more examples on the voluntary principle. So goods worth 45,000 naira on credit to Mike. Take notes on credit. So definitely this transaction is going to go through the day book, not the cash book. So goods worth 45,000. And first of all, we can see there that there is a sales and there is a mic. There is no cash. There is a sales and there is a credit to mic. So what will be the effect here? The effect is going to be the asset is going to increase, which is the mic's account. Mic now is a debtor to the company, and the company expects to receive a cash flow from mic in future dates. Then the second one is that there will be increase in sales. Sales account is going to increase, that means revenue is going to improve. So revenue is definitely going to increase. The word applying the entry principle, we say credit sales account, which is the giver, sales is giving out credit sales account, then debit Mike's account, because Mike is is one receiving the goods. But supposing it was a cash transaction, supposing we said sold goods worth 45,000 naira cash to Mike, Mike's name is not going to appear. The little account that this transaction is going to impact on is the sales and cash account. The reason why Mike's name is appearing here is because it's a credited transaction. Mike has not paid for the good which just sold to him. He's going to pay in future dates. Please take note. The next one, Mike returned goods worth 45,000, and the goods we sold to Mike, though he has not paid for the goods before, as you can see here, it was on credit. He has not paid for the goods before, but now he has returned the goods back to us, probably because he did not meet up with his expectation, or because of damage, or was also and so reason. So now, what will be the effect of this transaction? So either every transaction must have multiple, or let me say dual impact. So Mike sold goods. Mike returned goods worth 45,000 naira to us. What will be the effect? There will be decrease in the assets. The debt, which was Mike used to owe us 45,000 naira, but now that he reduced the goods worth the same 45,000 naira, it's no longer our debtor, no longer our asset. So the Mike is no longer owing us. So there will be decrease in asset, then increase in asset also. Return inward account is going to increase because the goods that Mike return back to us, we are going to add it back. We are going to add it back to our inventory. So applying the inventory principle, we are going to credit Mike's account, because this time around Mike is giving us our goods back. He's the one giving us this time around. We are going to receive it into our return inward account. Should the goods was actually sold, and now it has been returned back to the company. So here is a question. For the questions, the requirements for each of the lines above, you're expected to name the two accounts affected, then also identify the giver and the receiver. Is this simple? Just lay your hands on it, try and play with it. Just try and play with it. So please, if you have any questions to ask, you can drop it on the comment section, and I will attend to them one after the other. And also, if you know you have not subscribed to our YouTube channel, please kindly do that by clicking on the subscription button. You can also click on like. You can comment if there's any aspect of the video you want us to improve on. I think you welcome those ideas and work on them also. And please, in our next session, we are going to be considering subsidiary books and source document. That will be our next topic. Like I said, I'm going to take it step by step. We're going to take it step by step.